The views expressed in this program do not necessarily reflect those of this station.
Welcome to Insights into Northeast Michigan, a WBKB News public affairs program. Insights deals with the issues affecting those in the community, as well as Northeast Michigan and the state. And now, Insights into Northeast Michigan.
Good morning, everyone, and welcome to another episode of Insights. I'm Erica Fernandez, and I'm joined here this morning by Mark Ferguson, who is a financial advisor with Edward Jones. Thank you so much for being here today.
Thank you for having me.
Of course. So this week we're actually talking about the outlook on the 2016 economy, which has a lot to do with numbers and money and things like that, everyone's favorite topic. Yeah. So tell me, Mark, how exactly is the economy doing?
Well, the economy is doing very well, actually, and it might be hard for some to believe because we've had so much volatility in the last year and a half or so, but the economy's been growing at about 2% a year, which is very good. And there's a lot of underlying fundamentals that I think are very powerful in the economy. We still have a very low interest rate environment. We have very low inflation. Oil prices are low, which helps put money in consumers' pockets because we're all spending a lot less money at the pumps right now. And that's pure profit that goes into people's pockets. And if you think about our economy, what really drives our economy is consumer spending. So if their wages are good, their jobs are good, and we're in an increasing job environment, they have more money they have jobs. If they have jobs, they have paychecks, they spend money, they're actually spending more and saving more right now. So when we live in a country that is 14% manufacturing, that's not really what drives our economy. What drives our economy is consumer spending. So as long as jobs are going up and interest rates are low and gas prices are low, that really helps.
So we know about gas prices and jobs and things like that, but you mentioned interest rates. What exactly does that mean?
Well, there's a lot of chatter about interest rates. It seems like it comes up about every month. And I think the big concern, if you go back in 2001, the Fed raised interest rates 17 times, okay? Well, what does all that mean? Well, the Fed raises interest rates, kind of like you and I would tap on the brakes if we're driving too fast. So if we're driving too fast and we're coming up on something, we'll tap the brakes. Well, when we're in an economy that seems to, like it could overheat and become inflationary, the way the Fed handles that is they raise interest rates a little bit. That's like tapping on the brakes. So that makes it a little more expensive for people to borrow money. It makes it more expensive for companies to borrow money to expand their plants. So they raise interest rates to kind of tap on the brakes. The biggest question out there isn't if they're going to raise them. We know they're going to raise them because they're just about zero right now. The biggest question is when are they going to raise them and how high are they going to raise them? Because I think the fact that they're raising them is good because the inference there is that we're in a strong economy that could become inflationary. So it's nice if you understand that part of it, but I think what most investors are concerned about is, are they going to raise them too much, too fast? In other words, are they going to slam the brakes on instead of tap the brakes? Because economic expansions don't die of a long life, they're killed. And they're typically killed by raising interest rates too fast or oil prices going up. So every time the Fed has a meeting and talks about interest rates, of course, our ears are right to the tracks because we're wondering when they're going to do it. Now, about a month or so ago, they decided that they would only raise interest rates probably 2 more times this year, and it'd be later in the year. Up until a month ago, they talked about raising them 4 times. So if you imagine, they talked about tapping on the brakes 2 times now instead of 4 times. And that's when our economy or our stock market started to pick up again. So we went from being down 11% in January to being in a recovery from February till now, up 15%. And a lot of that was based on some of the positive news we were getting from the Fed.
So when the interest rates do go up, what does it affect? Everything that we do, that we buy?
Well, if you're going to go out and buy a car, there's going to be an interest rate on the loan if you have to borrow money, or if a company wants to expand. If a company is going to expand and they're going to issue bonds, that's basically a loan. So they have to pay interest on those bonds. Well, right now they're paying record low on interest rates. So it keeps more money in the economy. It makes it easier for for consumers to spend money. And again, that's what drives our economy.
So speaking of economy and money and everything, how are the jobs doing? Are the jobs improving? Are they declining?
Yeah, the jobs are improving very well. You know, we were at almost 10% unemployment at the bottom of the Great Recession. And now we're running in the high 4%, maybe around 5% unemployment. So the historical average for unemployment is 4.8%. 4.8% unemployment is considered full employment. We're just about there. So we've been adding about 200,000 jobs a month, which is fantastic, a little bit better than expected. We've added over 14 million jobs since the Great Recession, 10 million in the last 5 years. So we lost about 10 million jobs. We got back over 14 million. I've heard numbers as high as 18 million. Wow. So again, when more people are going to work and they have money in their pocket, they're spending it. And when they're spending it, it drives our economy.
So what about the Northeast Michigan area? I mean, are the is the job market doing well here? Because you hear a lot about it all the time.
Yeah, great question. And I suppose that one's really debatable. I talked a little bit about manufacturing and service economy. The thing that we have to understand in Michigan is we're a little bit unique. So we are in a town that's 80% manufacturing, in a state that's 75% manufacturing, in a country that's 14% manufacturing. Mm-hmm. Manufacturing doesn't drive the U.S. economy. What drives the economy is spending, okay? So it's kind of hard to answer the question. So locally, it's tough to have jobs, but there's some really great things going on at the Chamber. Jackie Krawczyk, Jim Klarich are doing wonderful things to bring businesses into Alpena, and that's going to be really positive for all of us. But it's hard to have perspective on jobs when we live in Michigan and we live in Alpena, because we're kind of looking through lenses that really are centered around manufacturing. But nationwide, jobs are really good. Here in town, I think we still got a ways to go.
Yeah, I mean, like you said, Alpena is such a smaller town, but the community is definitely doing something to try and bring in more economy. Yeah. What do you think are some of the bigger points that they're trying to make Alpena grow?
Well, I think they're trying to bring in some service kind of jobs, tourist kind of things. They're also bringing in retails, and some hotels and things. All those are good job creators, and they're draws too. They're draws to bring people to our area. So we've got some really great draws here. We've got our community college, we've got the Marine Sanctuary, we've got our hospital that's just growing. My understanding from the hospital, from some meetings we've had with them, is they're looking at like $70 million in investment over a 10-year period. I got some numbers from some of the management up there. The cancer, just to give you perspective, the cancer center was about $7.2 million roughly to build the cancer center. So when you think about the investment that's coming into our town just because of the hospital merger, that's like 10 cancer centers worth of stuff. Now that could be investment in technology, jobs, services, building, construction, who knows? But to me, $70 million coming in is good stuff.
All right, perfect. Well, we have to take a quick break, but more with Mark when we come back. Welcome back, everyone. I'm still here with Mark, and we are still talking about the economy. So, Mark, go ahead and tell me what's going on in today's stock markets.
Yeah, great question. And it's a little confusing because if all you do is you look at the return of the market year to date, it's up about 3 or 4%. But that really doesn't tell the whole story because markets don't just go steady. Okay, if you look back the last year and a half, last year the markets were down about 3. This year they're up about 3, but we started out down 11, came back 15, so we're net up about 3%. If you go back to 1928, just to give you more perspective, 1928, let me ask you this, in 88 years, so we tell our clients you're going to make 7 or 8 or 9% a year on average. So answer this question for me, Erica. Since 1928, in 88 years, how many times has the market done 9.5%?
I'm not sure.
One time.
Okay.
One time.
Okay.
So the reality is that markets, if you look at the last 100 years of the market, about 60% of the time they're really positive, about 30% of the time they're negative, and there's only about 10% of the time that they're in that sweet spot. So I think, while the markets are up 3%, again, it's not the whole story because the markets just don't chug along. They're up and down. They're very volatile right now. We think that's going to continue. And I think what people need to understand, what investors need to understand is that volatility is normal. We've been really spoiled for about 7 years. We've just seen a market that's gone from 6,000 to 18,000. So we've doubled or tripled our money, in the last 7 years, which is really unusual. But when you think about volatility and what is normal, what's normal is 3-5% drops per year, 10% drop per year, and a 20% drop every 3.5 years. In fact, if you go back about 100 years and you look every year on average, there's a 14% drop during the year. Well, when we say that to our clients, of course, they just look at us like we have two heads because they're not seeing that. But now we're starting to see it for the past year and a half. So What we're trying to say to people is we're going to get back to normal volatility, and they need to understand what normal is because we've kind of gotten away from that.
So should investors be worried at all?
Well, I think that if they have perspective on the market and they follow some basic rules of investing, I think they're okay. I mean, again, the underlying fundamentals are good. Interest rates are low. There's a lot of things that are moving in the right direction for the economy. I think when investors are worried, it's mostly because they're not getting communication from their financial advisor. Or maybe they're what we call an armchair analyst, where they're watching the news and the news is pulling them off in all different directions. And the hard thing is you can't let short-term events derail you from your long-term plans.
Right.
So yeah, investors are worried all the time, especially, I think the three biggest worries right now are what's the Fed going to do? What about oil prices? Because if oil prices go up and interest rates go up, that's really bad. And what's going on with China? You know, in getting back to interest rates, it seems like some people think there's just nowhere to run because the stock market's done really well. The bond market's at a peak. So if interest rates do start to move up, we could see some volatility in bond prices because they move opposite directions. So anyways, I think the biggest worry out there right now is China.
So what do you think that the economy is doing in order to prevent some sort of huge stock market crash?
Well, the nice thing about the United States is we have really good people at the Fed. I mean, they implement what's called monetary policy and fiscal policy. So monetary policy is when they're manipulating interest rates, for lack of better words, moving interest rates to try and manage the economy. The other thing is fiscal policy, where maybe they're changing tax structures or policies in government to make it easier for investors to invest or make it less expensive for them to invest. I mean, one of the things that's going on right now in the what we call the fiscal policy area is there's been a big change with the Department of Labor. So this was something that came out a couple weeks ago, was the Department of Labor has come out with some new rules for investors. So I think some investors might, as they hear more and more about that, they might worry a little bit about that. But again, they should be communicating with their advisors.
Always be educated about every
Always
aspect.
be educated.
Yeah. So you mentioned China earlier when you were talking about the economy. How do they influence our economy?
That's a great question, you know, because China only represents about 5% of our exports. So why would we worry so much about somebody who only buys 5% of our stuff? They're not a big customer of ours. Well, the reality is that China is a customer and a supplier of the world, okay? And when they have problems, it ripples into the world, and those are our customers. So there's a couple things that are going on in China. The biggest thing is that their economy has tripled in the last 20 years. So the growth of their country has been running at about 10%, and they recently slowed down to about 6%. Now it's kind of funny because 6% is 3 times where the U.S. is trying to get to.
Wow.
But this is a country that has consumed, a few years ago, 10% of the world's steel, which is the equivalent of 78 Golden Gate bridges per year.
Wow.
At any time in Beijing, there was 600 sky cranes building skyscrapers, okay? They were consuming 50% of the world's concrete. They're gluttons of oil, they're gluttons of natural resources, they're gluttons of commodities. So, and there's 7 Chinese people for every 1 American. I know this is a lot of numbers. I hope it gives you some perspective.
Yeah.
They're big, okay?
Right.
And they carry a lot of weight, and kind of where they go, we all kind of go. So when you have a country like that that slows and stops buying stuff and stops consuming things like oil, which is they're a big drinker of oil, that ripples back to other countries. So, you know, the interesting thing about China is that they have monetary policy, they have fiscal policy, they're doing a lot of the same things that we do in the U.S., and they've already lowered interest rates. All the things that we did 7 or 8 years ago, they're doing those things now. So they're going to get a handle on their economy. But structurally, they have some long-term issues. You know, one basic issue is they have a declining population. You know, China's a country that's built their country kind of on manufacturing, and they use, you know, low-end labor for that kind of stuff. So now you got a country that population is going like this over the next 40 years. They're losing their labor force, and they're not as high-tech as the U.S. So between that and their economy, they just have a lot of things to get their arms around over there. And what worries us over here is you know, how quickly they can get their arms around those things, because that's probably the biggest variable we have.
So would you say that they're not in a very good financial standing right now, or?
I'd say they're in a good financial standing, but you know, when 40% of their commercial real estate is uninhabited and 25% of their residential real estate is uninhabited, they just overbuilt. I mean, their solution to keeping their economy going was to keep people employed, keeping them building. So what you had is people that were living in the suburbs, there was urbanization, they were moving into the city. And when they built a building, they would go 10 stories underground for the workers because they didn't want them out in the open. So people were leaving the farms, coming into the cities. The cities were expanding, the construction was going crazy. And then all of a sudden they say, you know what? We got so much real estate and so much stuff going on here, we need to hit the brakes. And they hit the brakes, and it was, you know, they just have a lot to absorb.
All right, well, we have to take another quick break, but more with Mark when we come back. Welcome back, everyone. I'm still here with Mark Ferguson, and right now we're going to switch gears a little bit. Excuse me. We mentioned gas prices earlier in this segment. We've kind of seen the numbers fluctuate a little bit. How much longer do you think that we'll see the lower gas prices?
Well, that's a great question. I think we're going to see it for the near term. You know, I can't give you a time. Nobody can predict that kind of thing. But maybe I can give you some perspective on what's driving it down. Okay, we talked a little bit about China, how they're drinking so much less of it. The U.S. also uses less oil than it's ever used. It's only about 4% of our production of our country is based on oil. Our economy doesn't run on oil, okay? But the reality is that they're way overproducing. OPEC is in a disarray, if that's a great word for it. We have 525 million barrels in reserve. Well, what does that mean? Well, we normally have 400 million barrels in reserve. But here's the thing. So we're 20% over on our reserves. We're producing 2 million barrels more per day that are going into reserves. More than what we need, 2 million barrels. So every month that goes by, we add 20% more into the reserves, which we already have too much of. So if you have an oversupply and you have a shrinking or really dropping demand, what you're going to have is you're going to have lower and lower prices. So that's what we're dealing with, is lower prices in fuel, and which is great. I mean, I have 4 kids and 6 cars on the road. So, and summer's coming, I want to get in the boat. I remember 5-6 years ago when gas was $4.50 a gallon. My son drove to Florida. It cost him $140 this year. Would it cost $350 6 years ago? So when you start talking about gas prices at where they're at right now, that's fantastic, because think of the person in Alpena that goes to work every day and was spending $100 a week. Now they're spending $50 a week or $40 a week on gas. So that's $250 a month. That's a car payment for a young family. That's a huge thing. And that's just money that's going to go into spending, which is going to help the economy. So, you know, who knows where they're going to go. You know, Saudi Arabia and Russia right now, they're all maxing out on their production. And it's kind of a global game of chicken, is what I would call it. Nobody wants to back it off, because whoever ends up standing and producing will have the market share. So even though there's too much of it, no one wants to be the first one to drop off and drop market share. So the question is when's it all going to end? I don't know. I mean, I think it's wonderful that gas prices are low, and I'm just going to keep enjoying them.
Yeah, hopefully it sticks around. But you mentioned that we kind of have a lot of oil collected up right now. So would you run out, and then that's when the prices would go up, or how does it determine? So
OPEC is, just for in general terms, they kind of control the supply, and there's members of OPEC, and they kind of keep track of inventories. And the idea behind that is that there's always some reserve, whether it's a 180-day reserve or whatever. So they never really let it run out. They always keep a certain reserve, which is about 400 million barrels. So when they start to get too much of it, and the world's using less of it, the only way they can move it is to lower prices. So I think, you know, that's really, we're not going to run out of oil. There's too much of it. And there's also competition from other energy sources like natural gas. You know, there was a big find out in the middle part of the United States a couple of years ago. There's 150 years of natural gas underneath the United States. There's 150 years of coal underneath the United States. So there's a lot of other energy sources competing. So when you combine oversupply, overproduction, competition, you know, I don't know when oil prices are going to go up again. It doesn't seem like it'll be anytime soon.
Yeah, I hope it doesn't. So it is an election year this year. We see it everywhere. We hear about it everywhere. How is this going to impact the markets, though? Yeah,
great question. You had to ask a political question, didn't you?
I have to.
Well, I'm not going to get into that part of it.
Okay.
I was in meetings last week in St. Louis, Missouri, and we had former Vice President Dick Cheney in, and it was interesting because he talked to us about what he thinks is the #1 problem in our country right now, is that people are just angry at government. They just don't want a government kind of person in government any longer. So I don't know where all that's going to go, and I don't really have any comments on who should be there.
Okay.
But I will say this, what we tell our investors is don't play politics with your portfolio. Because the reality is that it doesn't matter what combination is in the House or the Senate or Congress or the President, the economy has always grown through those combinations. The stock market's always grown through those combinations. So politics don't really govern the performance of the stock market. The only thing the stock market cares about is if corporate profits are moving up. If corporate profits are moving up, stock market will follow. It might lag sometimes, but eventually it will follow.
So, oh, go ahead.
Well, I was just going to say, so don't play politics with the portfolio.
Yeah. So how do you think that the candidates that are, kind of running right now, how do you think that they're using the stock markets or the economy? Are they using it to their advantage, to their disadvantage? How do you think they're working that in?
I don't know. I haven't really followed it. I suppose everybody wants to claim, victory or claim responsibility when the stock market goes up, and they want to point fingers when the stock market goes down.
Right.
But again, there are so many things that influence it that the bottom line is the main thing is corporate profits. There's always going to be things beyond our control that'll be in the back of our minds. But as long as people are in the right type of portfolios and the market and the profits are moving in the right direction, the markets will go up, no matter what the politicians say.
Yeah, I think it also comes down to everyone just being educated about money, financial, the economy, and at the end of the day, I think that's going to help you make your best decision.
Exactly, exactly. Financial literacy is huge in the U.S. right now. When I started in the business 20 years ago, I think there was about 35% of Americans were invested in the markets. Now it's probably 55%. So just in the last 20 years, it's increased by 60% how many people are invested. Well, that drives how much knowledge is out there. It drives what the regulatory agencies are providing to people and how they control what we do every day. So, yeah, literacy is huge.
So do you have any closing comments for, the community of Alpena, whether they're, trying to figure out more financial education? Do you have any comments for them?
I think, of course, I'm in the business, so I'm all for professional advice. There's about 12% of our population, they change their own oil, cut their own hair. For all I know, they take out their appendix and pull their own teeth. I don't know. Okay. But about 85, 89% of the population uses a financial advisor, and I think that's really valuable. It's not an expensive thing to use an advisor. You can meet with an advisor for free to review your portfolio or to go over your goals and objectives, check your risk tolerance. I think what I would just close with is we can't predict where markets are going to go. We can't predict who's going to be president or what oil prices, interest rates, and all that stuff. What investors can do is prepare. And when 90% of the success of an investor's portfolio is driven by how it's diversified and if they're managing their emotions, those are the things that they should control. They shouldn't worry about things they can't control. So right now, if I was an investor, especially after the market's up a couple 100% in the last 7 years, my portfolio might be really out of whack. And I might want to understand also if I have too many bonds in my portfolio and if interest rates go up, how does it impact my bonds? Right. So I would say, get with your financial advisor, check your risk tolerance, make sure your portfolio is allocated properly based on your risk and your goals, your objectives, review your financial plan, and just have a sit down. Now is a great time to do that. All
right. Well, thank you so much for being here and for sharing all of those helpful tips.
Thank you.
Thank you. That'll be it for today's Insights. Thank you so much for watching.
Insights into Northeast Michigan is produced by WBKB News. If you have any comments, suggestions, or topics you would like to see on a future show, please email WBKB News. This has been a production of Thunder Bay Broadcasting Corporation. All rights reserved.
The furniture and set design for this episode of Insights is provided by Young Appliance Art Van Furniture on US 23 South, Alpena.